there's really two different types of life insurance. There's term, and then there's permanent. Term is very similar to renting a house, right? You need it for that period of time, and then you just don't need it anymore. So if I have a 40-year-old male, and they get $500,000 worth of life insurance, I'm probably gonna pay about $70 a month, and it's going to expire after about 30 years at 70, right when I need it the most. But the thinking is, that's all I need it for, because I have my investments working in a different area. Buy term and invest the difference, okay? The second type of term is called return of premium term, okay? Oh, wow. ROP term is where you get all your money back. Normally, ROP term is double the cost of your non-ROP term. So if I put $140 a month into the same 30-year chassis, I will get back every dime I put into it. So somebody do a calculation for me, please. $140 times 12 equals...
42.
Thank you. 1680, and 1680 times 30 is how much? 50,400. So I would get a check in the mail when I'm 70 years old for $50,400. That's return of premium term insurance. Okay? Go for it.
So if you die, though, in between there, you get the 500?
You do.
Well,
Exactly.
Your heirs do.
So when I'm describing it to a client, I go, which would you like? Would you like the type that you don't get anything back, or would you like the type that you get everything back? All I'm doing is bumping the conversation, right? So if you guys are familiar with selling up or pitching to bump, that's all, upselling, right? With permanent insurance, there's 4 different types of insurance. There's whole life, there's universal life, there's index universal life, and then there's variable universal life insurance, okay? All of them are built on a chassis that I call an egg. Jay-Z hates eggs. So the egg yolk is the cost of insurance. The egg white is the investment. All 4 are built on the same chassis, right? So if I get a whole life policy, I know that my cost is going to be X, but I also know that I'm going to get a fixed return on my investment portion. So if I put in $500 a month, this is a nugget right here. My question to the insurance representative is, how much am I paying for the cost of insurance? And how much is my portion going towards the investment? Okay? It's a simple question, but if they don't know how to answer the question, I'm not doing business with the agent. Most expensive, this is the Rolls Royce of life insurance right here, whole life. Least expensive permanent insurance is right here, UL. More expensive than UL, and right below whole life is index life, because you can manipulate the cost. And another pricey permanent plan is VUL. All are built on the same chassis. So let's just say, in this illustration, whole life is going to give me 5.25% rate plus a 1% historical performance dividend. That's about 6.25%, and now they go guaranteed. Naturally, we go, oh man, I get 6.25% guaranteed. That's awesome. But you ever play basketball and you're looking at the defender like this, and the guy cutting to the basket is the one you should have been looking at? That's the fees. That's the one to pay attention to, not the dude in front of you. Make sense? So I would ask, okay, 6.25%, how much is that costing me though? Because if I pay $300 for fees and 200 of it is going towards my investment, that means that my 200 is getting a 6 1/4 return, not the 500. Using this for case study example. Let's say my UL, in my UL, my cost is going to be 180 and my investment is going to be 320. If I get a 4% return, I'd rather have a UL versus a whole life. Why is that? My fees are less. One thing I can count on is my fees. Can't get rid of that. In my IUL, for example purposes, it's going to cost me 220 and the rest 280 is going towards that. And now I'm going to get a 0% floor and hypothetically speaking 10% cap. So I'm getting anywhere between here. VUL is not guaranteed, but the cost, again, this is just for an example. So, Min. So I've taken the liberty to create an illustration for you. Look at, your name is in lights, superstar. So this illustration has 3 specifics attached to it. Number 1, if you die prematurely, you meet your maker, your wife doesn't have to worry about the mortgages anymore. You have a death benefit associated with this. And like you said, you wanted $500,000 of death benefit, so that's right, created for you, okay? Number 2, it has this puzzle piece where if you become ill. So if you have a heart attack, stroke, or cancer, God forbid, they'll shore up that weakness and subsidize some of the income that has been lost within your family. I don't know if you know this or not, men, but 39.5% of men and women in the United States is going to get cancer. It's a fact right now. 4 out of 10 of you guys will have cancer in your lifetime. That's a fact, okay? Scary, isn't it? Yeah, I know. Some of you guys are already shivering. And then lastly is, if nothing like that happens, there's a pension plan attached to your insurance policy. So if you ever do any research, this is also called tax-free retirement. This is also called be your own bank benefits last. Is that cool with you, men? Yeah. As we get into the body of the presentation, I want to get your permission first and foremost to be somewhat blunt with you. Would that be okay with you?
Of course.
Cool. I'm going to ask you some uncomfortable questions, and it's not because I want to be a jerk or anything like that.
All my wife's in the room, have no idea.
Okay, cool. So, as you can see, the first year here, Min, you're 37 young years old. Okay? You put in $301 every single month. That accounts to $3,612 a year. Now, there's 2 accounts that you can put your money into. The first account is a 3% fixed account. By the way, that's 3% more than you're getting at your current bank. The other one is an indexed option. You might ask yourself, are these real numbers on the index option? And I'd say, absolutely. We're actually under-promising and over-delivering in this illustration. Okay? That illustrated rate is anywhere between 5 to 6. Now, mind you, I know that you're kind of technical. This plan does not have a cap rate. So if the S&P illustrated value does 12, you're getting 12. Make sense?
So there's no floor rate either, right?
Correct. Correct. Actually, no, there is a floor. Incorrect. So the floor is 0. There's another option where you can get a 1% guarantee with a 9% cap, but this one that I'm using is no cap with a 0% floor.
So that means if the market tanks, I don't go boo-boo.
That's right, you don't go boo-boo. So if you were to put in $301 a month, and a portion is going towards the insurance cost, which is about $60 a month, and the other portion that's going towards your investment, that investment does not lose any principal if the market goes down. Good question. Now, for illustration purposes, I'm just going to go through the indexed return. Cool? So after the first year, you put in $3,612. You got a 5.14% rate of return. Minus fees is going to equal a $2,759 account value. If you cancel the policy after the first year, you get 0. of course, the insurance company has to have some type of incentive for you putting all this money inside of the account and creating all these bells and whistles for you, okay? All the way to the right is your death benefit. Your death benefit is $500,000, so if you die prematurely and meet your maker, your family gets $500,000. Now, I know what question you might be asking yourself is, does my family get the 20-something hundred plus the 500 grand? And the answer is yes and no. Let me explain. The $2,000 is subtracted from the $500,000 of cost of insurance, which is what we'll go through in a little bit later, okay? I want to confuse you guys on this, okay? So at the first year, you're gaining cash value, which is pretty positive.
On the
Go ahead.
500 grand, it's 500 grand minus 27.
Information. There's 3 options to save and invest our money. They call this the 3 tax boxes. There's the tax now, there's tax later, and then there's tax exempt. Good, better, and best with respect to long-term savings. Yes? Tax now are your CDs, these are mutual funds, these are naked stock accounts, interest-bearing checking accounts, etc., etc. Do you have any of these, George?
Yes.
Awesome. Which ones? Checking. Anything else? This will give you a good gauge of the client. So when you ask the client that fact-finding question, now you're gauging where they're at financially. I got a couple mutual funds. Is it mutual funds inside of your 401k? Oh yeah, I do have them inside my 401k. Okay, do you have any naked mutual funds? Do you have any E-Trade accounts? Things of that nature. You're fishing, right? And they say yes, no, or maybe so. In these accounts, this is kind of like, who's a cook in it? Gina. Let's say I go to you and your husband's house, George, and you're cooking up carne asada. Who's the cook in the family? You or George? Right? I get her involved in the conversation. I ask her that question. She just became a kinesthetic client of mine. Make sense? So you are. Awesome. Let's say you're cooking carne asada. All right? And I'm starving. I go over with my buddy Pablo, and we're starving, right? You leave to the bathroom, we're cutting a piece. By the time you serve it, the carne asada is what? Smaller. That's just like taxation. In this bucket, you're going to have to pay either short-term or long-term capital gains taxes. Your short-term capital gains taxes is within 1 year. Your long-term capital gains taxes is after 1 year. And depending on how much money you make is going to be dependent on the tax percentages that you're paying, which are roughly, give or take, 20%. Okay? So let's just say I have $100,000 in my stock account and I make $10,000. I don't show this to the client, but I'm showing it to you guys so that you understand what long-term capital gains are, okay? So if I realize the gain, meaning I sell my stock and I put it back into my checking account, or I sell my stock and I leave it in my E-Trade, but I sold Tesla stock, but I made 10 grand. If I sell it within 1 year of buying it, that's a short-term capital gain. If I sell it after 1 year, it's a long-term capital gain. If I made 10 grand and my capital gain was 20%, how much would I pay, Ruben?
2 grand.
I'd pay 2 grand. So I would net 8 grand. Does that make sense, everybody? You follow? Sarah, this is what you wanted, right? Short-term and long-term capital gain taxes. If you go to Google, punch it in 15 minutes, you'll learn that. That's how accessible this stuff is, okay? Tax later. Now, this is a big bucket. These are your 401ks. These are traditional IRAs. These are SEPs for small business owners. These are KEO plans, TSAs for teachers, 403Bs, etc. So, the government says, Trent, we love you so much. We're not going to make you pay taxes now. We're going to wait to make you pay taxes. Just because we love you so much. They've created a magnificent rule called the 59.5 72 rule. Here's what that says. We're not going to make you pay taxes, but you have to wait until you're 59 and a half to grab your money. If you do grab your money prematurely before the age of 59 and a half, you're going to pay a 10% penalty on top of regular income taxes. So if you have 100 grand in your old 401k and you pull it all out and you're 42 years old, you're going to pay $10,000 in penalty on top of federal and state roughly 30%. So you're going to lose $40,000 for pulling it out prematurely. But the government says, we're in it with you. We're not going to make you pay taxes now. We're going to wait because we love you so much. Their interest rate is doubling too. Isn't that funny? Because the more money you have, the more they can take later on. 72 rule says this. Again, we love you so much. We're not going to make you pay taxes now. We're going to wait. But if you don't take out something called an RMD by the time you're 72, we're going to penalize you 50% on top of regular income taxes. True story. It's the biggest tax penalty in the tax code. Right when you're getting Alzheimer's, by the way. True story. Yeah? I'm telling you guys, there's 10,000 baby boomers turning 65 years old every single day. Another 10,000 66, another 10,000 67. The biggest wealth transfer ever in American history is happening right now. Well, you guys are learning. So do they need to learn these? Absolutely.